I get pretty enthusiastic, so I don't want to lose my voice at the end of it. But first of all, I'd like to thank Jana and Morgan and everybody at TradingPub for having me. It's a pleasure and an honor to be here. I want to thank each and every one of you, no matter where you are in the world. I want to thank you for coming. I appreciate it. I promise I'm going to teach you some stuff, and I want everybody to know up front that my focus is on trading weekly options and how I use math to generate fantastic short-term trading profits. Now, before I really get into it, you need to know that I have to put up a disclaimer, right? And all securities used in this presentation are for educational purposes and are not meant to be construed as a recommendation to buy, sell, trade any of these securities. All right, that's the official disclaimer. This is generally how I tell people. You know, when I trade, I look at the facts of the market and I make interpretations. And sometimes the facts don't change, but my interpretations change. Most people that trade try and pick the right stock going the right direction. And one of the neat things I'm going to show you is you don't have to pick the right direction. You just got to pick the right stock at the right time. So understanding you have to pick the right stock at the right time, there is a very large universe of stocks out there. There's 10,000 plus stocks, 3,000 plus of them have options available. A couple hundred have weekly options, right? We start with a large universe. We whittle that list down. We try and focus on very few. And I do that through my Pulse system. Now, Pulse is an acrostic, and many people think it's an acronym. An acrostic is actually an acronym on steroids because it spells something. And I use it as a memory tool or a teaching tool because I like to teach. And hopefully you like to learn. But P stands for profit potential, U is upside reward, L is low risk, S is setups and strategies, and E is events, entry, and exit. Now, the Pulse system becomes the basis of a course that I've made, which is a number of videos that are on DVDs. I write a weekly newsletter. In my newsletter, I have a watch list stocks that have the best math, the top 5 plus or minus, which are maybe the best math with either a technical setup or an event type setup. And then I review the previous week's picks, right? I jokingly say the emperor has no clothes because if I make a pick on a Saturday that a stock's going to move the next week, by the next Saturday, we're going to know if I was right or not. And then I constantly like to teach. And so I'm going to tell you this up front right now so no one's surprised at the end. At the end of this presentation, I'm going to show you how you can become one of my students. Having said that, again, I don't want to surprise anybody, so let me try and teach you in the meantime. All right, P from the Pulse system is profit potential. Here's an option that opened at 2 cents that traded up to over $10. That's 50% move, 50,000% move in one day. Now this is an outlier on the potential aspect. I just want you to know that there are massive amounts of money to be made following our system, right? So we have a lot of potential profit. That is not a typical trade, right? Here is a more typical trade. This is FCX. This is Freeport-McMoRan. This was from November of last year. This opened at 4 cents and traded to a high of 35 cents before closing at 30 cents, which is a 650% change from one day to the next, and almost a 9 times move from the open to the high on the same day. Now, 900% or 600% in a day or overnight is going to be more typical than 50,000% or 500 times in one day. and you might be a little bit skeptical that, that this is a typical trade, but I had a student that bought this option for 4 cents and he sold it for 32 cents and he bought 200 contracts. So, again, this is a bit more typical. It's to me, it's not an outlier. Here's another student's trade, right? This was Tesla. This was in January of this year. He bought 20 contracts of the 155 call at 60 cents, right? That's $1,200, and he sold them for $7.30. A $1,200 investment became a $13,400 gain. Right? So there can be some big numbers in this. This is maybe less typical, but this is an email that I enjoyed, right? It says, just a note to thank you for your insights into trading weekly options. I'm new to your techniques, but I've been trading options since 2005 with net losses. I sloppily applied your techniques to 2 trades this month and both were winners. On January 6th, I bought a single straddle on Micron, then at $20.85. Paid 89 cents for the call and $1.07 for the put for a total of $1.96. And on the 8th, I closed them for $3.11 for the call and a penny on the put, $3.12 with Micron at $23.20 for a 49% return on investment after commissions. Again, I said this is maybe not as typical, but this is one that I very much like. And the reason I very much like it is that this is not a stock that I had in the newsletter, but he or this student who had been trading options for almost 9 years with net losses took the technique that we teach, applied it onto a stock of his own choosing, and made 49%, right? And so one of the things that I really like about talking to this group is that you guys trade, right? And as traders, you're always wanting to learn more about trading. Now, this particular student continued the same email talking about Yahoo. He said, on the 22nd, I bought 4 Yahoo 40 put contracts at 40 cents with Yahoo at $40.08. I closed them today at $1.64 with Yahoo at $38.48 for a 277% return on investment after commissions. All right, so he's off to a good start. Now, some of you might not know what a put is. Some of you might not realize how much money he's tying up. I'm going to teach you this in this presentation. Right, I've got slides to show, but real quick, each option contract controls 100 shares. So at 40 cents, that's $40. So when he bought 4 contracts at $40, he tied up $160. This is one of the beauties of weekly options. You're not tying up huge, huge amounts of money. Again, a more typical trade. And when I take emails, I share them, I post them as is, misspelled words and everything. So here's a typical trade. Great call on your update regarding Chipotle Mexican Grill and FAS. So at 9:35 a.m. Eastern Time, he bought 10 Chipotle January week 4 $500 puts for $1.95. Right, this is $1.95 a contract. That's or $1.95 a share. 100 shares per contract. That's $195 a contract. 10 contracts would be $1,950. I can tell you that he paid $15.35 in commissions. Right. He continued that he bought 10 of the FAS Jan week 4 85 puts for 35 cents. That's $35 a contract times 10 contracts is $350, right? Plus another $15.35 in commissions. And he says, as the attached screenshot shows, I closed them out, both transactions for a one-day net gain of $6,500 and $38.44, and he says it's fantastic. So here's his a copy of the email he sent, and I'm not sure if we have a mouse to show that I can draw on. Yes, okay. So real quick, what I want you to see, first of all, his opening trades are on the bottom, and he bought them at 9:35 and 9:36 a.m. Eastern. Understand that the market opens right at 9:30. So basically, the market opened, he looked, double-checked, and bought. Later that same day, the market closes at 4 p.m. Eastern, and on a 24-hour clock, that's 1600. So with 4 minutes to go in the market, right? Hopefully you can see this in the left. I'm trying to move a mouse over it. I believe you're seeing some movement there. He sold to close, right? He sold the puts at 220. He sold the FAS puts at 220. He sold the CMG puts at 670. Again, $15 commission plus the fees, and you can see his net gain. Again, I started this presentation by saying most people want to buy the right stock going the right direction, and part of what I'm telling you is, as much as you want to buy the right stock going the right direction, it's maybe less important the time of day that you do it, as evidenced by the fact that he simply bought at the open and sold at the close. We're trying to pick the right days to trade, right? Anyway, Pulse, P-U-L-S-E, U stands for upside reward, right? Most trades make a minimum of 100%. And when I say this, I will lose on trades. Everybody listen very carefully. I will lose on trades. If I lose on a trade, I cannot lose more than 100%. The beauty of options are you're not obligated to throw in more money when you were really, really, really wrong. But you are benefited to collecting more and more and more and more money if you're really, really right. So I like to look for a trade that can make a minimum of 100%, because if I'm wrong, I want the next trade to absolutely make up for any losers I have. And L is low risk, right? And so what I like to do is I like to risk as little money as possible, trying to make as much money as possible. And one way to risk a little bit of money is risking only pennies per share, right? Whether you risk 35 cents like the FAS trade that he talked about, or $1.95 on the CMG, we find trades often more like the FCX trade, the Freeport-McMoran I mentioned earlier, that went from 4 cents to 35 cents. And if you've been a student of mine for a long time, you'll recognize the fact that we've hit FCX options that are right around a dime numerous times, right? And if we pay a dime and we're wrong, we can only lose a dime, right? And sometimes we get a better fill. Maybe we get it for 6, 7, or 8 cents, right? If we're wrong, we can lose 100% of that 6, 7, or 8 cents. But as you've seen, sometimes when we're right, we can get 4, 5, 6, 7, 8, 9, 10 times it or more, right? I like to think of the pulse as two sections. The first section is PUL, where we pull money from the market. And I say this is a white box system, meaning that I do not hide any of my methodologies, right? My methodologies are pretty carefully explained in my course on what mathematically will qualify and what mathematically will be rejected, right? And when we're looking at stocks, I kind of jokingly think we're playing the game of Clue, right? In the game of Clue, we're trying to figure out that Colonel Mustard did it in the living room with the knife, right? I have a lot of fun doing this. I write a newsletter. I've written for decades. Right? The first thing I was ever paid to write, I wrote a logic puzzle I sold to Dell Crosswords when I was 14 years old. Right? So I like the gaming aspect of this, figuring things out. I really enjoy doing this, and I hope that it shows. Right? And anyway, PUL is how we determine what stocks to trade. S&E determines how and when we trade them. So S is for setups. And we have two types of setups. We have a stock-specific setup or a market-wide setup. Now, a stock-specific setup might be because of a technical signal, right, using charting, technical analysis. If I see a signal that gives us a statistical advantage to trade, I will write it up in the newsletter, and the stock will move from my watch list to my top 5 plus or minus because of the technical signal. And then occasionally we have market-wide events. Tomorrow is one of those market-wide events. Now I'm going to tell you a little bit more about it when I get to E, which is events. So let me finish up with S strategies first. Again, S is setups and strategies. So we have stock-specific or market-wide setups. We then look to place a strategy on it, and we have just a couple of core strategies. We're not doing, anything overly complex. We either look to buy a straight call or a straight put, right? We either look for the stock to go up, we look for the stock to go down, and in the instances when we're not sure whether it's going to go up or down, but we're fairly confident that we're going to get a big move, we trade the stock with a non-directional strategy. And I'm going to fill in some blanks here in a little bit. All right, Pulse, P-U-L-S-E. E, right? E is events, entry, and exit. Let's look at the events. A stock-specific event could be a earnings announcement. That's the most commonly thought of. Here in a week or so, earnings season will start up again. I want you to know we do not buy our options prior to an earnings announcement looking for the company to have a stellar earnings announcement, right? Or looking for them to have a lousy, disappointing announcement. We wait until after the stock has released its earnings. We do this because the options are much less expensive. But that's an example of a stock-specific event, right? Not necessarily a stock-specific setup, but a stock-specific event. A market-wide event could be the Federal Reserve having their Federal Open Market Committee meeting, the FOMC meeting, which happens 8 times a year, of which they release the minutes 3 weeks to the day afterwards. So next week, there's going to be a market-wide event on Wednesday afternoon. I knew that this market-wide event was going to happen from over a year ago, so I can plan that. Well, sooner than next Wednesday is tomorrow morning at 8:30 Eastern Time. The Bureau of Labor Statistics is going to release the jobs report, right? Officially known as the Non-Farm Payroll Report. We abbreviate it NFP. At 8:30, they're going to tell how many jobs the economy has added in the month of March. Right? Additionally, they're also going to tell us the unemployment rate. Now, this is a market-wide event because the market wants to know how the economy is doing. They want to know if the Federal Reserve is going to continue with stimulation, right? Throwing money by buying bonds to try and keep long-term rates down. The market wants to know this, right? And the market analysts are making predictions what the results are. Now, we care less whether the results are good or whether the results are bad, right? We might have a personal bias. Oh, I'd love for it to be good because I want more people to be working, right? But we care less how good the report is. We care more on how accurate the analyst expectations are, because if the analysts miss their expectations by either under-guessing or over-guessing, and I use the word guessing on purpose, if they under or over-guess, the market's going to be shocked, and we're going to have extra volatility tomorrow, and we're going to have extra opportunity for profits, right? And we look to enter the market, like our trades for tomorrow. We either bought our options near the close of today, hoping to get a gap tomorrow, right, because of a shocking report, or we're going to enter our options tomorrow morning right near the open because we know we get shocked, and we're hoping that, and it's not necessarily hoping, it's an expectation that if the market gets shocked and gaps, it's not going to flatline. So our expectation, if the market opens quite differently tomorrow than it opened today, we're going to get volatility, and we're going to be able to capture that. So we're going to want to try and enter, right, too late for most of you, at the close of business today or at the open of business tomorrow. So someone that's got a full-time job can kind of plan ahead, that they don't have to sit in front of the screen all the time for many of the setups. Now, E also stands for exits, and we can exit by placing a target order out there, right? We can calculate what the option should be worth if the stock moves to a certain point, place that as a good till cancel limit order, and be satisfied with that. Or we can use a stop order. And when I refer to a stop order, I'm not necessarily talking about a stop loss order. I'm talking about a trailing stop. I like to have the stock move my direction, right? And then me be in a profitable situation and then raise my stop, trailing it as we go, and that way I'm able to capture the most money, right? And we basically try and do with options what people try and do in stocks by buying low and selling high. I always like to say that I should change this a little bit. I should put buy low underneath sell high, so it graphically follows, right? That we want to buy low, sell high. That's how you make money. We just do it on a leverage scale in very much shorter period of time than a stock investor or stock trader might do. Understanding that a stock investor / trader, their profits come one-dimensional. They buy low, sell high, and it's all about price, right? With the possible exception that a buy and hold stock investor tries to, maybe capture a dividend, buy a stock, collect the dividend. The real gains in owning stock is simply through appreciation, right? Buying low and selling high. Where options, on the other hand, are multi-dimensional, right? Multi-dimensional. And, without going, I will go into many of those dimensions about an option. Here's the bottom line. The reason to trade options, right, is twofold to me. It's how much could you lose? And like I showed earlier, that can be just pennies a share, but also how much do you use, which I showed earlier could be pennies a share. So if you're a smaller account, if you trade stocks, you're constantly dealing with putting all your eggs in one basket, and sometimes you can't guard the basket as carefully as you would like. With options, your risk is absolutely limited at the time of your entry. You know how much you could lose, and you can minimize that by buying, less options, less contracts. Again, we tie up very little amounts of money. But to me, the real reason to trade options is because they can be leveraged directional plays. Again, if you're a stock investor, you want to buy stock low and have it go up, right? Hey, I'm going to buy Tesla because I think their cars are great. right? You might say, hey, I want to sell Tesla because I think their market capitalization is outrageous compared to the number of cars they're selling. Well, if you trade stock and you believe Tesla's not a good company and you want to short the stock, you're going to tie up a huge amount of money. And if the market eventually agrees with you, but presently doesn't agree with you, you're going to lose a whole bunch of money. But with an option, you can play either direction, risking very little with lots and lots of upside. Now, the way we were able to risk either direction is because there are two types of options. There's a call option. It gives the owner of the option the right to buy the stock at a set price for a set period of time without an obligation to buy it. Right? A call option, when you think about it, is basically a bet that the stock is going up in price. Right? You get rewarded for being right that the stock went higher in price. The other type of option is a put option. A put option gives the owner of that option the right to sell the stock at a set price for a set period of time without the obligation. Now, put options can be looked at two ways. Put options can be considered a bet that the stock is going down in price, but put options can also be insurance. If you own a stock and then you buy a put option, you have the right to sell it at a set price without the obligation. It's like having an insurance policy. Hey, if the stock tanks, it's not tanking on me, it's tanking on someone else. Right? So there's two types of options, calls and puts. Calls a bet it's going up, puts are a bet it's going down. Right? And if you're not sure which, we have strategies, right? Those are our directional strategies. Now I want to talk about the non-directional strategies. First one, known as a straddle. This is when we buy, right? And again, my system is not based on selling options. I'm not doing credit spreads, right? I am buying options. So there's an inferred, we buy a call and put, right? We're buying, a straddle is a call and put with the same expiration and the same strike prices. Expiration is that fixed time, right? An option gives you the right to buy it or sell a stock at a set price for a set period of time. The set price is the strike price. The set period of time is the expiration. A straddle is basically a non-directional bet a stock will move. We don't know whether it goes up. We don't know whether it goes down. But since we've bought both the call and put, if the stock makes a move, right, a decent sized move, we're going to have a winner with one side and possibly a loser on the other side. And our, excuse me, our loser can never be more than 100%, and our winner can be 100, 200, 300, 400, 500%, 5,000%. A strangle is like a straddle. It is non-directional in that we're buying both a call and put with the same expiration, but these have different strike prices. Now, when we buy a strangle, we're buying a higher strike price call and a lower strike price put. We're basically strangling the price of the stock at that point in time, and we need it to break free for us to make a whole bunch of money. All right? And so a strangle is a non-directional bet a stock will break out. Straddles will make money more often than strangles. Strangles will make more money than straddles, but not as often. All right? And we have very specific rules on when to buy one versus the other. I would say the majority of our trading is with strangles. So I've talked, straddles and strangles are non-directional. Right? I've mentioned in the newsletter, we try and find a reason to trade a stock. Right? A reason might be a stock-specific event, such as an earnings report, but we trade after the earnings release, not before. If we don't have a directional bias, we buy a straddle or strangle. If we have a directional bias, we buy a call if the directional bias is up. We buy a put if the directional bias is down. This is from my November 2nd newsletter, right? I wrote, quote, if Tesla gaps up, right, that gap up is referring to the earnings. We're talking about Tesla releasing its earnings. If upon releasing its earnings, the market really likes the earnings and it gaps up, I feel that after a gap, that it's likely to reverse and head lower, right? So I wrote, I feel the reversal has a higher likelihood of being a better trade. If Tesla gaps down, right, which refers to it having bad earnings, right, and that the market didn't like the results, I wrote, I felt the continuation has a better chance. The continuation means that if it gaps down, it's going to continue down. Basically, I said buy Tesla puts after the earnings announcement. And then I remind you, if you can always hedge yourself by buying a strangle, buying both a call and a put, right? So in the newsletter, we have an event, we announce the event, we pick the stock, and then I share, my years of experience. And I want you to know, I've been in this business. Next month, it'll be 36 years that I've been paid to help people invest and trade. So I've been around the block for a little bit. Anyway, I got a testimonial email from a student 5 days later. He said, Thursday at 9:39, I bought 5 contracts of the 143 puts on Tesla at 42 cents. Right? So before I read the rest of the email, I want to make sure everybody understands this. 9:39 is just after the market opens. Right? 5 contracts, each contract controls 100 shares. He paid 42 cents a share. 42 cents times 100 shares per contract is $42. Times 5 contracts is $210. Now, to some of you, $210 is nothing. To others of you, $210 is a lot of money. The bottom line is he could have invested any increment of $42. He could have bought 42 for 1, 84 for 2, right? 210 for 5 like he did, 420 for 10. Could have bought 100 contracts for $4,200. It's all within the budget. There's enough liquidity on Tesla that, we're not out on a limb here. Anyway, he then placed an order to sell at $1.50 and left. It only took him 2 minutes, and he had more than doubled his money, right? He had more than tripled his money. He commented that I suggested puts no matter where it opened, and it worked. Right? This is a more typical trade. Here's another student, a different email I got the next day. As a newer student of 3 or 4 months, I had a great week trading your system. Here are my results. I bought 1 Tesla November 149 put for $1.38 and sold it for $6. That's $138 becoming $600. And I'm going to tell you something. When we get a really good setup, it doesn't matter which strike price you buy. When we get a really good setup, you do not have to trade our system with precision. And I want you to know that any system that requires precision in trading is a system that you will eventually fail at because you can't be precise. Right? It's hard to be precise. We call it sloppy slop. Sloppy slop works. Now, excuse me 1 second while I take a drink. Right? Sloppy slop works. The 143 puts work, the 149 puts work, all the puts in between worked as well. I say sloppy slop works. Here's the student. He bought the 143 put for 42 cents. He sold it at $1.50. A couple of days later, they traded to $10 plus, right? He was happy. He bought them. He placed a target order. I want to tell you, if he would have put a trailing stop, he could have got a much better fill. He could have exited here somewhere in the $3.50 range, maybe somewhere up here in the $5.50 range, depending on how wide or tight his stops were. Maybe he could have gotten lucky, but our system is not based on luck. It's just based on a mathematical advantage. Right? We teach that mathematical advantage in our videos on our DVDs. Right? We talk about it week after week in the newsletter. Again, in the newsletter, I've got, well, probably 36 stocks that have the best math. And then I look for the top 5 plus or minus. It's been as few as 1, right? It's been as high as 12, but it's generally 5 stocks plus or minus. Last week's newsletter, there were 7 stocks in it, right? We pick stocks, we tell the reasons why, and then we review the previous week, and then we try and educate you all along. And in educating, I do what I call a trip. This is a trick and a tip. I combine trick and tip, and I get trip. And I tend to trip over myself when I try and, I get all excited. Oh, here's a trick, or here's a tip, or here's a trip, right? My whole goal all along is to teach you how to exploit a setup. So one of the DVDs contains a video on trading Schlumberger. Ticker is SLB, and if you read Schlumberger, it might look like Schlumberger, but it's Schlumberger. And I have been trading this stock for decades. I consider myself a slob trader, right? A trading slob. SLB being the ticker, throwing the word O in there to be cute. Part of my effort, part of the reasons I be cute is to make you learn this, to teach you, right? I try to make it non-forgettable. Whether it's memorable or not, I don't know, but non-forgettable. So here's an example. Here is Schlumberger on January 24th of this year. It opened at 4 cents, right? The day before it closed at 3. It opened at 4 cents. It traded up to 36 cents. It ended up closing at 6 cents. But from 4 cents to 36 was a 9-bagger. That's a 900% move. You don't have to trade with perfection if you get a move of 900%, if you can go in and grab 100, 200, 300% of it. Right? If you bought this at a dime and sold it at 30 cents, you made 300% and you left a lot of money on the table. Right? And Schlumberger repeats. Here is a chart from the 97 call on Friday, March 28th, 2014. Feel free to look it up. This is last week. This is 4 trading days ago, or 5 if you want to. See, I'm really, I don't know if it's 4 or 5 days. Anyway, this is from Friday of last week. This option opened at 15 cents. It traded to $1.35, and then it kind of sold off and closed the day at 50 cents. And you can see there was just a slight little pullback early in the day, right? It had gone from 15 cents to over 40 cents, and then pulled back to 20, and then basically kind of ran up with very little pullbacks to $1.35 before it basically just rolled over. That's a 900% move. And there's a number of entry points that you possibly could have gotten in. You don't have to get all 900% to make money, but if you're a slob trader, right, you have opportunities that present themselves week after week after week for big gains. Again, I try and teach you how to do this so that you can do it on your own. This last week, Slob was not in my newsletter, but I mentioned there's a video on trading this one stock alone. Now, I focus on short-term options, right? And quite often, I look to buy an option Thursday near the close or Friday near the open, but we will get setups that we can buy Monday during the week, right? And try and write it out. So here's an Apple option from last week. It had 3.5 days of entry points under 50 cents. And then it, with a low of 17 cents, and then on Friday it hit a high of 17.05. So, here's a short-term gain on Apple, but we don't only talk short terms. So in my July newsletter of last year, I said, hey, buy Apple options. Buy the Apple option where the premium is just under $3. Right? Understand, when I write on a Saturday, I do not know where the market's going to open up on Monday. I don't know where it's going to be on the Friday before, so we set certain rules. Our rule in the 727 newsletters, just buy long-term options, and I don't care what expiration you buy the option that's just right around, preferably under $3. So here we have the October 500 call that opened at 270, right? It was 81 days before expiration. 81 days out. So the same rules that we use for weekly options can be used for someone that's not prepared to trade weekly options. This stock, Apple went up, and this option went from $270 to $4. The 520 call, which is $20 further out of the money, so it's now $80 away from the stock price, right? The stock was about $4.40. This option opened at $3 and went to $4.12. If a person wanted to buy some time to be right, but was satisfied with a 33% profit or 35% or whatever it works out to, and get it in a day, they can take it, right? They can take it. But if you were able to stick with the trade, here's that same Apple 520 call, right? The November 520 call. And in just over 2 weeks, it went from $3 to $25 on the high, right? So occasionally we'll write about, right? Occasionally we'll write about, and I got to tell you something, I don't write about long-term options often, but when I do write about them, you should probably pay attention, because I don't write about them often, and since I focus on short-term options, when I change focus a little bit and throw a longer-term one in there, pay attention. Right? That's a little trip, as I call it. That's a trick or tip to consume the newsletter. All right, again, the pulse system, I think there's a dozen videos, plus or minus, I don't know, on however many DVDs they put. I probably should know this, but I focus on the newsletter. The newsletter is generally around 20 pages, but a lot of the pages are charts and graphs, and so I'd like to think it doesn't take much time to read. It takes me a long time to write. Trust me on this. You might not realize how much goes into it, because I make it look so effortlessly. Oh, I'm joking. Anyway, again, there's a watch list of about 3 dozen stocks. I try and take the top 5 plus or minus from that watch list because of either a market-wide or stock-specific setup, and I write about them in detail. We review the previous week, so again, if I'm right, we'll know within a week. If I'm wrong, we'll know within a week, and you will get to learn week after week, right? We teach. So earlier this year, I had in my top 5 on January 18th of 2014, I had 4 stocks. I had FAS, Chipotle Mexican Grill, VXX, and Yahoo, right? And here's a chart of looking at VXX, right? We had VXX open at 14 cents, traded to $2.20, open at 6 cents, traded to $1.17, open at 10 cents, trade to $1.47, open at 4 cents, trade at 75 cents. These are 15, 16, 1900% one-day moves, right, on a stock that made the top 5. Right? Again, the newsletter was published on January 18th. This was the 24th, right? Basically, on the Friday when the leverage is greatest, here was the trades. newsletter shortly thereafter, right? February 22nd, my top 5 was 4 stocks: BlackBerry, eBay, Schlumberger, right? Schlumberger doesn't often make the top 5, but when it does, you should pay attention. And Tesoro, right? Here's Schlumberger. Opens at 22 cents, goes to $1.83. That's 7 times in price. BlackBerry opens at a dime, goes to 29. Boo hiss. That's all. Boo hiss. Terrible. That's just shy of tripling in price. What a terrible trade. I apologize for suggesting that one. eBay, right? eBay opened at 9 cents, right? This is the Monday. Opened at 9 cents, went to 55 cents. But that option by the end of the week hit $2. $9 on Monday. $9 on Monday became $200 before the end of the week. So this begs the question: if you buy it at $9 Monday morning and you can sell it at 55 Monday afternoon, are you disappointed that if you did so, to find out later that it went to $2? Right? We call that sloppy slop, right? Because you don't have to trade it perfectly to make decent money, because the setups we talk about have so much upside, right? Here's Tesoro from that same trade, right? It opened at 35 cents, went to a high of $1.32 before selling off fairly quickly. So part of it, is on my shoulders for picking the right stocks at the right time and then giving you all sorts of details to help you trade them as best as possible. Part of it's on your shoulder, right, to be accepting, a massive return and leaving some money on the table, right? Buying for 9 cents and selling at 55. Let's say you bought it at 20 and sold it at 40. Can you be okay that it goes to $2 later? Right? If you cannot be okay doubling your money in one day, I'm not your guy, because, well, first of all, I am your guy probably because I can show you how to more than double your money in a day, but you know what? It's on your shoulder after that. You've got to have some responsibility in this trade at all. And that's why I think the education, that I offer is maybe the best, because I'm going to tell you something. The longer you're my student, the less slop, right, you'll have in your trading. I have students that have been with me for years and years and years. And I don't call you subscribers because I call you students, and many of you I call friends because I've gotten to know you. Yana, I don't know if you're able to, you can put this link so they can click on it directly, maybe right out of the chat or however you do it. I'm going to talk about it a little bit, what it means to be one of my students. We have a 3-month trial, right? The 3-month trial is, first of all, the subscription is $97 for 3 months. I don't make any money you becoming my student, right? I make my money you staying my student. And I say I don't make any money you becoming my student because what I'll give you, if you sign up for an initial 3-month period, I'll send you all these videos, right? You'll get to watch these videos, right? Learn my system. I will send you 90 days worth of newsletters, and if you quit at any point in time, we'll give you your money back, right? If you stick, we're going to renew you for another 3 months at $97. At which point in time you could quit at any point in time, but you're only going to get a prorated refund of what's not used up from that point forward. So I hope that I've made the presentation well enough that you say, hey, look, I want to try his system. And then it's on my shoulders to do a good enough job for you to stick with me. And if you're okay with me telling you about stocks ahead of time, right, that we're disappointed when they make only a 300% move or a 400% move, right? I think you're in the right spot, because we do find lots and lots of moves that make about 800%. I like them to make it in a day. I'm probably more better if we make them overnight. Having said that, I think, Yana, you've put up the link, and I'm going to try and look at some of the questions. So I'm going to stop this from scrolling by so I can kind of read some of them. So I had one guy say, before I sign up, I'd like to learn and try a few options to feel comfortable at trading options. Yeah, that's the beauty of our the initial thing. You sign up for it. If you don't like it for whatever reason, just cancel. If you feel you're not capable of doing it, cancel. I think I've been told, and I believe, and I strive for, and I try hard, I think I have one of the highest renewal rates of any newsletter writers in the industry. And part of it, is because I'm not saying, hey, look, I think stock XYZ is going to triple in price by the next 2 years, and then you got to stick with me for 2 years to see. I say, hey, look, this is going to have an option that doubles or triples next week. We're going to know right away, right? So I think people can see if I'm able to deliver on a short period of time. The next thing is, can it connect for you? And I do my best to make sure it connects for you. And it always breaks my heart when somebody signs up and cancels. And I say to myself, I know it's not because of anything I did. It's maybe just because of their life it didn't fit. But my system works, as you shall see. All right. So someone asked, would you explain the strangle again? The call is the higher strike price than the put. And what we're trying to do, we are using slightly out of the money options, and sometimes we use a very out of the money option because of the math behind it, looking for the right setup. And so when we buy a strangle, we're buying a call just above the stock price and a put just below the stock price, hoping that the stock makes a big move the next day. Question, do you use market or limit orders? As a general rule, I use limit orders, but the stocks we tend to trade have so much liquidity that often I might use a market order, but not the first 30 seconds of the day. Is there much liquidity in the second tier options? Yeah, that's part of the pulse systems. We reject stocks that don't have liquidity. Do we teach students how to find those types of trades? Absolutely. I love it best when one of my students picks the stock for me for my newsletter, and we give you guys credit, albeit we give you credit by giving your initials credit because we don't share your names. Question about the watch list. Are you saying if we buy straddles or strangles at the beginning of the week, will at least one strike price double? Those are the watch list has the math that says there will be occasionally slower weeks, but we teach a thing called EV, which is expected value, and I believe the expected value of our setups is that we will have at least one option move 100%. You talk as though you never have losers. Oh, I think I disagree. When I buy a straddle or a strangle, I will have a loser on the call if the stock goes way down. I'll have a loser on the put if the stock goes way up. And here's the thing, if my put loses 100%, but my call gains 900%, we're going to call that trade up 450%. Someone asked about Forex markets. I don't trade Forex, so I can't answer that. I do not trade binary or Forex options. Excuse me. Can you trade this in your IRA? Absolutely, you can trade this in your IRA. Someone asked me who's a good broker to use. I think there's a lot of good brokerage firms out there. I tend not to choose one or another. When a person becomes a student, they can send me an email and ask me that question, and I'll tell them the brokerage firm that I use, my assistant use, and the one that we use in common as a backup, but I don't want to publicly share that at this point. Someone asked about where do you get options charts. Typically, the free software available on the web doesn't chart options, but the brokerage firms, they allow you to chart options. Do you tell people when to get in and when to exit? It's much easier on a Saturday to tell people rules of when to get in for, let's say, next Thursday or next Friday than it is to excuse me a second, to tell them their exits. So we try and teach a system to help the exits, and part of it is understanding sloppy slop. If you buy something at a dime, right, and it goes to 30 cents, if you get out, you're pretty happy. And if it goes to 90 cents, are you disappointed, right? Well, my answer is no, because the next time you should get in a dime and write it to 40 cents. And then as you get better at it, you'll write it to 50 cents and so on. I can't, someone asked how many DVDs. I don't know how many DVDs they put it. There's like a dozen lessons that they've put on a handful of DVDs, because there's a lot of details in the course, but I try not to put in a lot of fluff. I mean, I really try and get into the nuts and bolts of it. Can you touch base on the mathematical formula you use? Absolutely. I basically get involved in understanding implied volatility, and implied volatility is an annualized number, and then I de-annualize it to a day or weekly number. So when I asked you, understand I'm offering a weekly newsletter service, and you referred to DVDs. The beauty of what we have as a special for TradingPub is that if you sign up now, we're going to give you the DVDs. The DVDs are normally $195, and then you subscribe for $97 a quarter. And then we often run a special of $97 for the first quarter, and we give you the DVDs for free. Do you use high beta stocks also? Yeah, and for those of you who don't know, beta, it determines on how much a stock moves in relative to the market as a whole. Again, we have about 3 dozen stocks. I think Tesla, Chipotle, some of these high flyers are on it. Google's on the list, albeit Google did that stock split, so I pulled, I haven't traded Google. I got to let the dust settle to figure out exactly how the options go on it. So some of these stocks move fairly high. I mentioned FAS, which is a 3x bullish banking sector, so it moves 3 times as much as the banking sector, so its beta would be higher. None of this stuff is really, really complex, in all honesty. Can one do this without a broker? I just buy and sell on the net with Fidelity or Schwab. And they say, how do you structure selling puts? I don't sell puts. I buy a put. I'll sell a put for a profit, right, occasionally for a loss. But I use my brokerage firm, whether no matter what firm you're using. And there's a lot of these questions, so I can't answer all of them. So one guy asked, many options educators dismiss long option strategies in favor of shorting option strategies. Can you discuss, why do I go long? Because when I can make 900% by being right, the math tells me why I go long. Yay, we got a student here who says that they love my system. Yay, thank you. Can you trade commodities or indices? One of the stocks listed on this week's newsletters was the SPY, Spider, and you could do that, in a futures account trading SPX, I would assume. You cannot lose more than you invest. That's the beauty of buying an option. That's why I don't like shorting option strategies. Are these predominantly weekly options? Predominantly, that's where the best setups are. Again, one of the slides I talked about Apple buying the longer term options on it, and can I start with only $1,000? Absolutely. I've had students start with smaller accounts. I've got a new intern. He started with a $3,000 account, and he's hit like 7 things in a row. So he's selling a bunch of stuff to his father to put money in his trading account. Do my strategies require trade adjustments? As a general rule, no. Is the system based on technicals? We will get technical setups that we discuss, but we're based more on the math that goes into option pricing. I want everybody to understand that the option pricing model won the Nobel Prize for economics, right? And I've studied this formula inside and out. I've been doing this for, like I said, it'll be 36 years this May. And my DVDs go into it. I look a little bit different the way the market works, and we have found an inefficiency that we exploit. So I want to ask what the cost is after 3 months. It's a recurring $97 quarterly subscription. If you decide, again, you can quit at any point in time. Can we download your Excel spreadsheet template? Yes, somewhere. I'm not the tech guy that does that, but we can give that to you. Will you ship DVDs outside the U.S.? Absolutely. I've got students all over the globe. So they said, is the newsletter average picking 5 options? I pick 5 stocks on average, plus or minus. And some of the setups, there were 7 stocks this week, and 5 of them I talked about entering on Thursday near the close or Friday near the open. So each edition is different. The market gives you different things. All right. What is your percentage of winners to losers? I think I have more winners than losers, but I actually have not personally gone through and counted them. You said you did what with puts? We buy our options, trying to buy low, sell high. Does your broker consider you a day trader? Here's the thing. If you have an account, a margin account of less than $25,000, right? You can avoid this by not opening up a margin account. But if you have a margin account, and ironically a margin is so they can loan you money, but they won't loan you money on options. So if you have a margin account of under $25,000 and you do more than 3 day trades in any rolling 5-day period, they'll call you a day trader. So that's part of the reason, like in the newsletter I wrote, hey, we're looking to trade non-farm payroll on Friday. We could wait for the report to come out on Friday. By Friday morning, options that are expiring Friday afternoon, they have very little time value, very little time left to expiration, therefore very little time value in the options. They're very inexpensive, but we might want to buy them Thursday near the close, hoping to get a gap in the market and thus avoiding any possible day trading regs. So when I ask when the newsletter is emailed, technically, I promise you over the weekend, and I've been doing this for years and years and years and years, and only once did I not get it out on Sunday night, Saturday night or Saturday afternoon. That was because of a technical glitch, but it arrived on Sunday. Trust me, I want to get it done and spend the rest of the weekend with my family. So someone says, what do you do when time decay is destroying the premium? Well, when we buy it in the morning for 8 cents, it can only destroy 8 cents. We buy, inexpensive options with very little time left because there's very little time decay left. Is it possible to trade Eastern Time 9 GMT to 0? The GMT's kind of got me off there. If you want to rephrase that, I'll try and answer that. Someone asked, what's the consequence of being listed as a day trader? Not a big deal if you have over 25,000. They're trying to protect you from yourselves. And so there are ways around it. And someone asked, my newsletters, we post them, present them, we ask you to download them. I guess I'm not sure. Someone asked if they're not, previous ones aren't posted on the website. I'm not the website guy. I can't answer that. So what do you get for the quarterly subscription? You're going to get a newsletter every weekend, right, with education, picks, recommendations, whatever you want to call them for the next week, and a review of the previous week. Plus, if you sign up now, we're going to give you all these DVDs. All right, so Bill sends a thing here. The newsletter has been my favorite learning tool. Sometimes it takes a while to get the hang of it, but when you get it, the results is like mulching, immediate gratification. Thank you, Bill. The newsletter is a PDF. You can print it. Richard, you asked about the DVDs. Email me that directly, and we'll solve that problem for you. Someone said it's getting late in the UK. Good night. I have two of my best students are from the UK. Do you always trade on Fridays? Well, Fridays are where the most leverage is, where the options are the least expensive and the leverage is greatest. All right. All right, so I'm mostly caught up here. Jana, are you with me?
I am, Chris. Are you done answering the questions?
Well, I'm losing my voice, so.
Well, I think everyone should be very happy.
Here's the bottom line. I think, it costs me money if you subscribe and cancel, right? I personally, Chris, I make my money off renewals. I want you. Here's my goal. I want everybody to listen very carefully. My goal is to teach you how to do this on your own so you don't need me, but to do such a good job of it and present more and more new tricks, new setups, new great advice that even though you can do it without me, you want to stick with me. My goal is for you to learn this on your own. My hope is that you've made so much money that the $97 a quarter is so inconsequential that you won't cancel ever. And I have students that have been with me for years and years and years. So, here's how it works in the stock market. If you're a stock investor, you've got to find a stock, right? You want to buy a stock that has a good product or service, right? Think about Microsoft 10, 15 years ago, or 15, 20 years ago. I'm getting old. They had MS-DOS, right? A disk operating system. That was a good product or service. They had on the drawing board, right, or in the pipeline, they had Windows 3.1, and pipeline was Windows 3.1. Drawing board was Windows 95. The brain trust to come up with Windows 97 and all these things, right? So you invest in the company because they got a good product or service, a good product or service in the pipeline, a good product or service on the drawing board, and the brain trust to continue with more. If you invest in that company, and you're right, you make a lot of money, right? Now, if the company doesn't pan out, you can lose. But think of it this way. My return privilege, my guarantee is like a put option. I believe I've got a good product or service. I believe I've got good product or service, next week's newsletter, right, in the pipeline, the newsletters after that on the drawing board, and the brain trust to continue. If you invest with me and you feel that it's not true, exercise your return privilege, send the stuff back to me. Other than that, go on a ride with me and let's make tons of money together. The stuff we trade has so much liquidity that if we get a dozen, or 1,000, wouldn't that be great, new students, we're not going to change the market because we're trading an option on a stock, and the stock's still the dog that's wagging the tail. Anyway, Jan, I again, if you put up that thing, I apologize if I did not answer all of your questions. I try and do a good job, and it goes back to sloppy slop. I know I'm not going to do it perfect, but as sloppy as I do it, myself and my students make money. And if you want to join us making money, you're welcome into the family.